I mean, so much hinges on the messaging from the Fed. I mean, it does feel like the market is, pricing in too much optimism. When you take a look at the rally that we've seen in recent days, I mean, it's priced for disappointment.
Morning, Haslinda. Thanks for having me today. I mean, let's just think about the setup. The setup, what we had was housing data that was coming off, consumer sentiment coming off, soft data telling us that there might be some room for slowing, but the hard data isn't so, right? You look at wages, unemployment rates, they're still very much in a tight labor market. And you had the rest of the central banks kind of going at a slower pace, wanting to intervene. We know the pressure is outside the US, and which is why the market is reacting to what it is. What we have is we're still thinking about the 75 basis points in the couple of days, but the market will also have to take solace in what data is going to come. Fed has told us they want us to look at the data, and the market will take the Fed and then watch the data.
The thing is, the Fed has made it clear it will get rates to restrictive levels and stay there. It's not just about getting to restrictive and then easing.
Absolutely. We have disagreed with what the market is doing in terms of cuts. How we are thinking about this is that levels are restrictive. And how do we think about restrictive? If you see the Fed's forecast in 23-24, nominal growth is there about 4%. If they think about a 5% rate, we are 100 basis points above neutral rate. And that in itself, if you think about a rule of thumb, 4 quarters above, that is somewhere that they are happy neither to talk up or talk down the level of rates.
How, I mean, just a couple of days after, I mean, we're going to be also getting what's happening with regards to the employment situation. Non-farm payrolls are out then, and, that could actually unleash a Pandora's box if we do actually see something like wage growth suddenly accelerating more than anticipated and the unemployment rate also just drifting higher.
Absolutely. I think where we're kind of thinking about payrolls, or the market is thinking about it, is when do we revert to the pre-COVID, pre-pandemic type of levels for the NFP, given that we are kind of seeing a rise in the payroll numbers. So I think anywhere between this 100 to 300 number was where it was. The market wants to see a trend basis going to that. And if numbers are going to go up way higher than what the market expects, I think we're going to go back to where the market has to price in more rate hikes again.
So tell me here, Howe, I mean, how does this must be throwing up all sorts of opportunities for you with regards to what you're looking at fixed income-wise. I mean, you can look at the yields, attractive, but what happens if the price goes further down? So, surely investment grade is one thing, but high yield there must be some amazing opportunities as some of those companies have slipped down the rungs of the ladder.
Absolutely. I think how we think about duration is going to be on 2 counts before I go to high yield. On duration, I think this is a world that active duration has to be going to be managed. As we were saying, it's not cast in stone where the Fed hiking cycle is going to go to. The market keeps looking for a terminal rate, but the Fed itself doesn't know where it has to be until we know where inflation settles, which is why active duration management is going to be extremely important. Front-end rates, as we have mentioned, I mean, think about this. If you're going to get 4.5% in 2 years, a high-quality credit, 150 basis point on top gives you 6%. You got to, with that roll down, you got to have rates going up 300-400 basis points before you lose money on the short duration.
You have to talk about China. Slew of bad news, property sector getting smacked front and center. What's the outlook? What would it take for the government to do to reverse that course?
I think first off, what we're seeing over the last 10, 15 days in terms of China equities, China credits, what we're seeing in the markets, is not going to be the one that's going to drive the macro picture for China. China remains steady in terms of how they think about where they want growth to see, but the mix of how they achieve that growth is going to be different, right? The priority on where they want the central government or government-led sectors to kind of take the lead, the mix will have to change. But for us, China growth still remains a function of what happens in the near term with COVID management, as we see pressures are still remain very much there. Number 2, with regards to the property sector, right, whether they feel that they are able to kind of arrest kind of the drop in there. And then number 3, which is what the external environment is about. With the US and Europe, if we're talking about the slowdown, it's going to be very difficult for China to kind of get a much boost from exports.